So again, good morning. Thank you for joining. I can see a few more people just coming in as I'm speaking, but I thought we'd get started. My name is Mitten, and I'm a partner at Secondsight. We are part of Foster De Novo, a large national independent financial advisory group. And Secondsight basically is the corporate arm of that division, is a corporate arm of that business where we focus on employee benefits, but also specifically more recently around financial well-being. And we've been running these financial fitness shows, excuse me, we've been running these financial fitness shows since the first lockdown. I'm pleased to say we were inspired by Joe Wicks, of all people, when he was doing his Get Fit and his PE stuff. We thought maybe we could do something, similar around financial fitness. And I'm pleased to say it's got a pretty good following. I can't say it's got as many as Joe Wicks, but we haven't received any gold discs from YouTube yet. But we do have really good feedback on these sessions. And for those of you that aren't familiar, it's a short sessions, 30 minutes. I'm going to be introducing my guest, Caroline Bateman, in just a minute. And the idea is that I've asked her a few questions that have been polled online as the most popular questions. And we'll have a bit of a discussion. And then there's some Q&A at the end. So a chance for you to then ask your questions, and hopefully we can be specific about those. So today's inspiration, motivation has come from the National Talk Money Week, which starts next week. And we've got this session today, and then there's another session next Friday, which is around budgeting, saving and investments. But if you go on their website, the idea about Talk Money Week is to get people talking, as you can imagine, about money, everything from pocket money to pensions. And today's subject is actually around pensions. So there's lots of benefits of talking about money, according to their website. And I'm not talking about boasting about money. I'm just talking about openly talking about money. But the research shows that people who talk about money make better and less risky decisions. So that's really important. They have stronger personal relationships. So I think it's been a bit of a taboo subject, talking about money. We also help our children, or it says it helps their children, or our children form good lifetime habits. And that's the sort of thing that we want to be encouraging as well. And if we've got time, I've got a little anecdote about that, but we may not have time with one of my children who I've just got starting to save. But also because if we talk more about money, we feel less stressed about it, less anxious and more in control. And for those of you that have been on previous sessions with Darren, he often talks about this feeling of being in control of your finances. As one of the definitions of financial well-being is low levels of financial stress. So hopefully these conversations are all going to help us feel a bit less stressed about our money, which can only be a good thing. So with that in mind, let's crack on with the show. For those of you, as I said, are new to this, it's very simple, 30 minutes, chat to myself and Caroline. So Caroline, I'm going to introduce to you, is one of our employee benefit advisors. So she's actually in the workplace advising individuals on a daily basis around their own individual retirement plans, their long-term financial plans. And the questions that I'm going to be asking her are ones that we've been saying to you, the audience here. What is it you want to ask about pensions? So there is a Q&A function on the session today. So please do complete that as I'm going through, and then we'll get to the questions at the end. So Caroline, are you there? Can you dial in?
Hi there. Yeah, I am here. If you'll hear me, I can't start my video though. I think the host needs to allow me.
Okay. See if that works.
Try again. Here we are. Hello.
Excellent.
Hi Matt. Hi everyone watching. Nice to see you.
Yeah, nice to see you too. You look very well. How are you?
Yeah, good. Thank you. Pleased it's a Friday. Yeah, no, I'm good. Thank you. I'm good.
Excellent. Well, as we are short on time, I hope you don't mind if I just sort of crack straight on with the questions, and then that gives us more time for Q&A at the end as well. So
sure.
My first question, we get asked this an awful lot of the time. I say we, I know you do as well, but I mean, because of auto enrollment, right? Everyone's got a pension now, so we don't need to worry, right? I mean, should we be worried about pensions? I mean, a lot of people think that now we've got one, we don't need to worry. Whereas the question people seem to be asking is, how do I know if the pension I've got is the one that's going to get me on track to what I need? What are your thoughts?
Yeah, I think people are very much guilty of that, Matt, especially the younger generation. You know, they seem to think, I've got a pension, retirement's sorted. But that's not always the case. You know, you're automatically put into the pension on default contribution rates, but default isn't necessarily the retirement you want. So it's really important that people think about the retirement they want, which is difficult if it's far away, but try and, you know, picture the retirement you want and then forecast forward to see if you're on track to get that retirement. Forecasting is really important, because if you don't know what you're on track to get, how do you know if what you're doing today is right? So it's really important that people forecast, and there's a couple of ways you can do it. Before you do anything though, you need to start gathering your pensions, and with automatic enrolment, people have lots of pensions now. So gather all your pensions, no matter how small, find out who the pension provider is and try and get an up-to-date fund value. The best way you're going to get an up-to-date fund value is registering online with the pension provider that you've just discovered you've got. So register yourself online and get an up-to-date fund value. Once you've got that, don't forget to include your state pension. The state pension is provided by the government, and lots of people just sort of neglect it or push it aside. It's actually a really nice top up when you do get to state pension age. So best way to check your state pension age and to see what you're on track to get is to go to the government website. It's gov.uk/check your state pension or check state pension. That will tell you your state pension age and what you're on track to get. Once you've got that, you can then start forecasting. Now, there's a few tools. Some of the pension
providers. Can I just interrupt you 1 second there,
yeah.
Caroline? Just on the state pension side, I know it's something a lot of people do overlook or just brush to one side as being relatively sort of insignificant.
Yeah.
What sort of level is the state pension at these days if you were to get the full state pension?
You get the full state pension, and to get the full state pension, you have to pay 35 years worth of national insurance by the time you're at state pension age. It's £179 a week. It works out to be just over £9,000 a year. I think it's £9,339 a year.
Right.
So
that's a guarantee, isn't it? So that's really valuable.
Yeah, and people think, oh, it's not enough to live off, but if you get the full state pension, and if you're married, that's 19 grand almost coming in. So yeah, it is a nice top up, and you see that in the forecasting tool. You know, I do a lot of forecasting, as you said, and you see that when they get to state pension age, it tops up nicely. So yeah, it is a really nice thing to have. I think people neglect it wrongly. So yeah, so once you've got your state pension and you've got all your other pensions, you can start forecasting. Some of the pension providers have a forecasting tool. So those ones that you've registered online with, check their websites, they may have one. If not, there's loads of free ones. The ones that come into my mind are pensionmonster.com, Money Helper, the money advice service. You've probably seen some of the adverts online. These have forecasting tools. Of course, you can engage with a financial advisor. They're always going to have a really sophisticated, sexy piece of kit. But there's always forecasting tools out there. So you can have a look at what you're on track to get if you continue doing what you're doing at the moment. And once you've done that, you can then decide if that's what you want. If you're happy with it, happy days, log off and go away smiling. The likelihood is, though, that you're going to want to change something. And there's 4 things you can do to make that forecasting thing look a bit better. 2 of them you can do are changes you can make, but the other ones are sort of thinking about things. So the things that you can think about are what you're actually wanting to get at retirement age. Again, it's tricky if you're far away from retirement because you don't know what life holds for you, but you've got to try and fast forward to retirement age. So if you envisage being in your 60s, if you've got a mortgage, is it paid off? If you've got young kids, are they, fingers crossed, going to be dependent by then? They tend to be the most expensive things in people's lives. So if you can knock off your mortgage and shut the door on your kids and just see them at Christmas, then what does your outgoings look like? We at Secondsight, we tend to have 2 suggestions for a target. So the first one is your absolute essentials, you know, putting food on the table, paying your council tax, etc. And then you've got your leisure one. So that's if you want to go on a couple of holidays or, you know, go off to Spain or whatever it is you want to do. So you have 2 targets, and then you can see what you're on track to get between those 2. The other one you can change is, of course, your retirement age. Now, you know, I'm in my 30s. I love the idea of retiring at 55, which is the earliest you can retire, but trying to be realistic. What is the earliest age you'll be able to retire? When are you realistically going to retire? Most common age now is mid-60s and in line with state pension age, which is getting later depending on when you were born. So have a think about realistically when you want to retire, and age has a massive impact on what you're on track to get. Not only if you retire early, not only are you not paying into your pension for as long, but you're taking money out of it for longer time, and your state pension isn't kicking in for X amount more years. So retirement age will have a big impact on your forecast. A handy little tip, which some people don't know, is that you can actually delay, if you defer your state pension age by a year or two, they actually enhance the state pension that you get. So your state pension increases by the equivalent of 1% for every 9 weeks you defer. So it works out to be 5.8% for every year you defer, which can have a big difference if on your forecast.
Okay, that's really, really helpful. So I've got my forecast. There's some questions coming in, which we'll come back to later about how maybe you sort of track down pensions and bits and pieces.
Yeah.
But let's assume I can get all that information. I'm putting it in there. What about how much I should be paying in? That's often probably the second most kind of frequent question we get asked. Are there kind of any guidance you can give around contribution levels, how much I should pay in, that sort of thing?
Yeah, so I think once you've got your realistic target, when you realistically were going to retire and what income you're going to need, then you can work backwards to what you should be paying in today to reach that target. And that all depends on what you've previously done and your age, basically. So everyone will have a different target, but to give you some numbers, because I know everyone likes a number. If you can assume your target is 2/3 of your salary, so whatever salary you retire on, and assuming retirement age is 67, because that's the current state pension age. So if you're 67 and you want to retire on 2/3 of your income, then what do you need to look to pay in today? Well, if you're 25 and you're just starting out in your retirement or pension journey, then you need to look to pay in about 11% of your salary. If you don't pay in your 20s and you start paying in your 30s, if you're 30, you need to look to pay in 16%. If you're 35, you need to look to pay in 20%. And if you're 40 and you've just started paying into pensions, then you need to look to pay about 1/4 of your salary into pensions. Now, anyone in their 40s will tell you that's just not achievable. That's the most expensive sort of time in your life. So it's really important to get what you pay in correct, or as near to correct, as soon as possible, because the cost of delay is really big. And don't forget though, those numbers that I've given you are total contribution. So it does include your employer contribution. So if you're that 25-year-old just starting out who has to pay 11%, let's say your employer pays 5%, you just need to top it up to 6%. So it does include your employer's contribution as well. But yeah, the cost of delay is really big. It
really does pay to start early. I know that it's never probably the most exciting thing young people can look forward to, saving into a pension, but I think when you speak to everybody who's sort of in their 40s and 50s or even their 60s, they'll tell you they wish they started when they were younger. And yeah, based on those numbers, it really is it does get very expensive if you leave it late. Obviously, quite a lot of numbers banded around there. And one of the questions we get asked, I should say that this is being recorded. We'll put it onto YouTube so people can look back later. But one of the sort of general rules of thumb I was given many years ago was that basically, if you're starting out, it's roughly half your age as a percentage of your salary. Very rough rule of thumb. If you can remember nothing else, then you're putting in about half your age, then you should be okay. One thing that's really helpful. Go on.
Sorry, Matt. I was just going to say one thing I would just add is that if you're looking to increase your contributions, but those numbers sound a bit daunting, check your employee benefits, because sometimes if you pay in more, your employer will pay in more. So it's, that's free money. Yeah. And that just seems to me like a logical step. So if you increase by a certain amount, your employer increases too. So that's always your starting point if that's something you're thinking of doing.
It's a really valid point, Caroline. I advise a lot of companies and we do sort of governance at sort of a corporate level. And it always surprises me how many people are only sort of going in at the minimum level when employers do offer generous matches. As you said, free money, it's there for people to take advantage of. And, the number of people that still don't do it is quite staggering. So, again, hopefully as a takeaway today for those people that are listening, go out there and see if you can find some free money in Money Awareness Week. So that's really good. Thank you very much. So we talked a bit about forecasting, talked a bit about how much to save. Where should I invest my money? Where's the best place for me to get my returns that are going to make me a comfortable retirement?
Yeah, that's another thing that you can do today to change your forecast. And it's a question that I get asked a lot, especially sort of in the past 18 months when the pandemic's hit, everyone's saying what's going on with the investment markets. So when you were put into if you've been automatically enrolled into your employer's pension, you would have gone into the default fund. And the default fund is default because it's deemed most appropriate for most employees. So it doesn't mean it's a bad fund, but it does mean that you've got the choice. You've got a choice of hundreds of funds available to you through your pension provider. So it's nice. It's just important to know you've got the option to change should you want to. So as I said, pension providers have hundreds of funds, all different in one way or another. So a good starting point, check the fund you're in and see if you're happy with it. Lots of employers go into, they don't just randomly pick it. They do a lot of sort of due diligence on the fund that they want to go into, and they do pick the most appropriate one for most people. Also check if your employer offers some sort of advice. We at Secondsight, I have like 6 meetings a day offering advice to our clients. So if your employer does offer something like that, and that's also a good starting point to engage with an advisor and see what chat they can have with you about risk and the fund that you're invested in. But if you're going to go and choose your own, the biggest thing you need to decide is the level of risk you're happy to expose yourself to with your fund. The more risk you take, the more potential for growth there is. But of course, the potential is being the word, because the risk is that you'll potentially lose some money as well. Generally speaking, though, pensions are a very unique investment, and you'll have a different risk appetite for different areas of your money. The money that you get in your bank account, which you pay your bills with, you're going to be really risk averse with that, because if you don't get paid that, then you can't eat. But the money that goes into your pension, think about the time scale of that investment. The earliest you can touch this money is 55. I said earlier, the most common retirement age is mid-60s. How long a time scale is that? Generally speaking, the longer term an investment is for someone, that will be their riskiest investment. Doesn't mean it's going to be 100% in risk. It's going to be as much risk as you're comfortable taking, because you've got the time scale. And therefore, if there is a crash in the markets, and just like the past 18 months has shown us, no one knows what's coming. If there is a crash, you've got time on your side for those markets to recover. So what we tend to find is, if it's a long-term investment for someone, they will take a level of risk with the idea that they de-risk themselves as the timescale of their pension shortens. And that goes hand in hand with the size of your pension as well. If you think about when you're just starting into your pension, it's not worth a great deal. So if you do lose some money, maybe it's 50 quid, 100 quid. If you're in your 50s, your 60s, you've been paying in for so much longer, your loss is bigger. You're now talking maybe a couple of thousand. So it goes hand in hand with the longer the time scale and the smaller the pension pot, the more risk you'll take, or you may feel comfortable taking. And then as you get older, you de-risk yourself.
Yeah, I think it's one of those things that most people are probably quite afraid of doing on their own, because it's quite complicated, and unless they're sort of operating in this space. I personally think that the insurance companies and pension providers should do more to help people in this area, because I think the language is a bit scary, and we're lobbying for all of that sort of thing. And it's not easy for people. So I do sympathize 100% for people, and that's often why people end up just staying with the default fund. So I think at least someone is overseeing that. And we should say that most default funds have been designed, as you said already, for the majority of people. They're unlikely to be bad funds. They're going to get a lot of focus. So you shouldn't worry too much about that. But I think for those people that have more specialist needs, and either they need to know they've got to do that research themselves, or they're probably going to have to pay for some advice, aren't they? I mean, one of the things that we should probably talk about, because it's so topical. We've got COP26 happening up in Glasgow, the climate change crisis. What's the pensions industry doing about that with regards to where the money is being invested? How do members know that their money is going to the right places? Or do they? Yeah,
there's been a big push in sort of environmentally friendly funds or ethical funds. Now, pension providers for years have offered what's called ethical funds, but recently they've introduced something called ESG funds, which stands for Environmental Social Governance Funds. And like you said, it's a really hot topic, especially this week. It's a great week to talk about it, actually, with the climate change conference and everything. So the whole idea of these funds is they seek to invest in companies that are deemed to be investing in the environment or social and governance. So they're looking for companies like that. And you'll be surprised at some companies that you'll find within the ESG bracket. So an example I always use is BP. They're in some of the ESG funds, and you might think BP, it's an oil company, how the hell have they found themselves in this? But because they're so heavily invested in renewable energy, then they're seen as being part of the ESG movement. So yeah, it's a big push in all the pension providers providing these sort of funds. Ethical funds are still available, and ethical funds are they look at a pool of funds, and then they screen out ones that are deemed too unethical, if that sounds that's a really weird way of saying it, but if a company is deemed too heavily invested in something such as fracking or tobacco and things like that, then they're screened out of the profile. So rather than being a screening out process, ESG funds look to screen in companies that are doing good.
That's right. So I think they're trying to influence change from the inside rather than just exclude them sort of just because they don't meet certain criteria. And actually, we're seeing more and more default funds including ESG elements to their core proposition. So there is still a limit to that. They're not all fully kind of invested 100% into ESG yet. It's something that everyone is moving in that direction of travel. It's a positive story, and we're seeing some positive change on that basis. And there are certain providers out there which I think are leading the way, and there would be information about that. Either speak to your HR people or potentially your pension manager or whatever size organization you work for, or potentially you could go onto the providers' websites themselves. I'm sure they will be talking more about what they're doing from an ESG perspective. But I think when it comes to investment, I think the thing to sort of maybe explain to most people or that I think is helpful when you talk about risk and investment is that when you're investing in a pension fund, you're investing in a wide range of companies. So you are going to get this nice, what's called diversification, where you have lots of different companies, small investments in lots of different companies. So you're not overly exposed to, hopefully to be too overly exposed to one particular sector, one particular location, etc. And as you said, time is your friend here. You have a long period of time to invest this money, tens of years potentially, and therefore that does enable you to take potentially more risk than you might do, as you say, for your day to day. We've talked about a number of things. We talked about a little bit. It'd be useful to talk about how you can actually access your money. So people can access it, you said, from 55, although that's pretty rare. What are the kind of ways that people can kind of say, I've finally been saved all this money all my life. How do I now get hold of it?
Yeah, and I think, in the meetings I do, it's really nice to have context, no matter how old you are, to how you draw your money, because it makes it a bit more real. You're not just putting money away for this thing you don't understand. Yeah, there are two popular ways of how you can draw your pension pots now. The first one, which used to be the only way, so is a word that people might be familiar with, is an annuity. And what annuities are guaranteed income for life. So you get your pension pot, you go to the insurance market, and they'll say, if you give me that pot of money, I promise to pay you a guaranteed income of whatever it may be. So obviously, the bigger the pension pot, the bigger that income is going to be. The great word within the annuity is the guaranteed element. You know exactly what you're getting from the day you take it up until the day you pass away. However, there are two downsides, I guess, to an annuity. The first one is because we're all living a lot longer now and we have low interest rates, annuity rates have dropped, which means you now have to hand over much more money to get an income back. At Secondsight, we present this slide that kind of gives it in context, and it looks at a man that's age 65 and has £100,000 in his pension pot. Back in 1990, that £100,000 would have bought him an income of £15,000 a year. Today, it would have bought him an income of £4,000 a year. So that's a drop of more than 2/3 wow, just from the annuity rates. So you can see that has a big impact on what you're getting. And the other downside to it is, unless you build in sort of money for your spouse when you die, and the more you build in, the more your annuity drops, then your annuity dies with you. So again, that's a big downside to annuities. The upside to them, of course, I've already said, is that you've got that guarantee that you know what you're getting every year. So a few years ago, another way was introduced. It was passed through the Pension Freedom Act. It's often referred to as drawdown. Some people might know it as flexible access. And what this allows you to do is take your money how you want to take it. So you get to choose every year the income that you want. So you could say, this year I want £10,000, next year I want £20,000, etc. This has some great benefits. The first one is it recognises retirement's changed. You know, I always think of my granddad. He worked at the gas board all his life, up to 60, and then retired fully from a Monday. Now, people like to go into what we call semi-retirement. So they like to go part-time or take a less stressful role. Because they've semi-retired, they actually work a lot longer. So you now find people working much into their later 60s, early 70s perhaps. With the semi-retirement, they can use their pension to top up that loss of income that they've taken. So that's a more popular route now, rather than working full-time and then going fully into retirement. Another beautiful thing about drawdown is it recognises, and it always sounds so cheesy when I say this, but it recognises that retirement is a journey. You know, you're retired for hopefully 20, 30 plus years. So your spending habits at the beginning are going to be very different to your spending habits towards the end. Again, I always use the example of my parents and my grandparents, both retired, both spend money very differently. You know, my parents just retired, spending money like it's going out of fashion, doing their kitchen up, buying new cars. My granddad, obviously 20, 30 or years so older, pays his bills, does a weekly game of bowls, but spends a lot less. And drawdown allows that flexibility. So you can access more of your money at the beginning with the idea of slowing down later. And of course, another great benefit to it is that it doesn't die with you. So whatever you haven't spent can pass to your loved ones, which is a great benefit, and actually changes the way people think about retirement now. They now think of it as more of a savings vehicle, not, I mean, yes, for retirement, but also just generally for the family. So that's a really crucial benefit. I
mean, when you describe it like that, drawdown sounds like it's got all the pluses going for it, and annuity sounds like a bit of a kind of a throwback to a sort of dark ages.
Yeah.
Are there any downsides to drawdown at all, or?
Yeah, there are downsides. The biggest one being that obviously no one knows when Judgment Day is coming. So you've got this pot of money that you've got to make last till you don't know when. And, you know, we're all guilty of, you know, getting excited at the beginning when you get your pension and thinking, oh, I'm going to go on all these holidays and go and upgrade my car, just like my parents are doing, even though, you know, I'm advising them not to. So you get all excited, but you don't know how long you've got to make this money last. And I know people are always increasingly worried about, you know, the end and care homes and things like that. So you've got to manage this. We are finding a lot of people engaging more with financial advisors to help them with that. But yeah, drawdown is still probably the most popular route that we're finding.
Okay. Thank you. Well, that's almost perfect timing. In fact, it is perfect timing. We've come to at 11:30. So what we've covered off today, we talked about the state pension, how to get on track, stay on track, where to get some forecasting tips from. We talked a little bit about investments. Very difficult to talk about investments, such a generic space, because people often have specific questions about their own circumstances, which obviously we're unable to answer today. We talked about how much to pay in and also then how to get your money out as well. There's obviously lots of questions coming in, so let's run through some of those. Yep. The most popular one seems to be about people got lots of pensions dotted around. Okay, some of them are saying, should they consolidate? Some are saying, look, I used to work for a previous employer, I don't know who that employer's pension was anymore. I imagine some of these are probably trust-based as well, potentially. So I think the question is two questions. One is, how do I track down old pensions? And the other one is, once I've tracked them all down, what should I do with them? Should I consolidate them all?
Yeah, so if we answer the first bit about how do I find lost pensions, there's a great website, it's called Pension Tracing Service. So if you pop that into Google, you put in your employer's name and the years you worked there, and it will bring up who the pension was with. So that's one way of tracing your pension. Alternatively, of course, you can contact your employer, but depending on how long ago we're talking, they might not have the information. So Pension Tracing Service to find your pensions. Once you've found your pensions, if you're thinking about consolidating them, there's a few things to think about. The first one is, some people will have what's called defined benefit pensions or final salary pensions. They are a bit of a different kettle of fish. They have very good guarantees and security. So the rest of my conversation is not including defined benefits. What you want to do is check out what's called the annual management charge. Every pension has what's called an annual management charge. It's dictated by the average contribution getting paid in, if it's a company pension, the size of the employer, etc. So everyone will be different. Even if it's the same pension provider, there'll be a different charge. Check your charge. Makes sense to move them to the lowest charged scheme. And that might not be the one you're actively paying into. So there's no harm in having a couple of pensions. Lots of people think I only want one. There's no harm in having a few. But yeah, it does make sense to try and consolidate a few if you do have, 10 or so. So the annual management charge is something you want to look at. And just bear in mind that some older pensions, and I'm sort of talking pre-2008 now, but some older pensions may have exit penalties or things like that attached to them. So just check that out as well. But yeah, hopefully that's answered the question.
Yeah, no, that's really helpful. Thank you. There's other questions in here. Back on one about ESG funds. It says, I've heard that ESG funds generally don't give you as good a return as non-ESG funds. Is that true?
No, I think it's there are newer ways that you might be better answering this question, Matt. But
I've been taking it if you like,
a lot more research into it. But no, I don't think that's the case.
Yeah, no, I think what we're seeing now in ESG is it's become much more mainstream. I think the concerns were historically that you were investing in a much smaller universe of funds that were probably deemed more ethical as specifically, and therefore would have excluded a lot of other funds. But actually what we've seen ESG fund wise is quite a lot of technology companies fall into ESG. They've obviously done very well. And there are a number of examples where you would cite actually that ESG funds have done better than mainstream funds, particularly in the downturn that occurred as a result of the financial crisis from COVID, because all your airline stocks, all of your oil and gas stocks, all of those traditional funds did really badly, but actually your more sustainable investments where businesses were focusing on more sustainable like climate change, etc., did better. So I would argue that what we're seeing in many instances is the ESG funds performing better than mainstream funds rather than the other way around. I've got a question here about drawdown. Is it subject to any form of tax or is it tax-free?
So with drawdown, drawdown and annuities, you can get 25% of your pension pot tax-free. The remaining 75% is subject to tax, just like your tax on your income today. So if you take an amount that makes you fall into the basic rate tax, then you'll pay 20%. If you take an amount that is a higher rate, you'll pay 40%. So you've got to be aware of that as well. Lots of people think, oh, I can access as much money as I want. Yes, technically you can, but you could pay a large tax bill with that. Okay,
thank you. There's a question in here about taking your tax-free lump sum and whether it's best to take your tax-free lump sum or should you leave it in your pension pot when you get to retirement?
That depends what you want your money for. Not often do you get tax-free lump sums. So lots of people like to take the tax-free lump sum, but it very much depends on what you need your money for. If you don't need the tax-free lump sums, then there's a benefit to keeping it in there. With drawdown, you can either take the 25% at the beginning, or when you take it, if you don't, every time you take an amount out, you can get a bit of that bit tax-free. So there's an incentive to that as well, because you can be quite clever with that, keep yourself below tax barriers. So really the answer to that question is it depends what you need them, if you need the money and what you need it for.
Thank you. I'm just looking back here through some other ones. So question here from someone says, I have a pension I can start to get access to at 55. How does that work? And how do I go about getting that? And if it's an option I want to go for, perhaps also talk about the dangers of taking your pension and keeping working because it restricts future contributions. Maybe just mention that as well. But what are the kind of options?
Yeah, so you can access your personal pensions from 55. If you want to start accessing your pension, thinking about that, then the first thing to talk about is that pension provider. Find out what they offer. Again, talk to a financial advisor about the best route to go down, whether you want to go annuity or drawdown. Remember, the earlier you start taking the pension, just bear in mind with the forecasting, it's going to run out quicker unless you go down the annuity route, which is exchanging it for that income. Yeah, Matt, you mentioned about if you start drawing your pension, the contribution. So everyone has what's called an annual allowance, which is £40,000 at the moment. So you can pay up to £40,000 into your pension a year and get tax relief on that. Once you start drawing your pensions, that annual allowance drops and it drops to 10,000. So it's quite a drop. So again, if you're going to take your pensions at 55, that's great. But if you want to continue paying into it, just bearing in mind the amount you can pay in is going to drop.
Okay, thank you. Another question here, is there a minimum number of years ahead of your retirement which makes it worth increasing your contribution? So is it worth increasing contributions when you say 3 years away from retirement, for example?
The old answer would have been probably not, but the new answer with drawdown is probably yes. So with annuities, what you do is you have this pot of money and exchange it for an income, and that small increase nearer the time isn't going to have a big enough impact to get that money back in the income. With drawdown, actually, because you can access the money how you want to, if it's beneficial because you can get tax relief on the money that you're paying in. So the money goes into the pension, you get tax relief on the money that you pay in, you get tax relief on any growth that you get from your fund. So in theory, if you wanted to, on your 54, when you're 54, you can pay all this money in, and from 55, take it out with all the tax relief added. So yes, it is worthwhile. Yeah.
Yes, I think so. I think because the money is invested for that length of time, you're seeing it now not as a 3-year investment, but maybe as a 23-year investment. So, it does make sense. And again, depending on how soon you're going to draw that money out, it remains in a tax-free environment for many years. So it makes sense to certainly consider that, and maybe alongside some other options. There's a question here about if you're looking at buying your first home. I don't know if you can answer this, Caroline, but do mortgage lenders tend to look upon high pension contributions favourably? Do you know how they might view that?
Well, not really. I guess the only thing I could comment on that is around salary sacrifice, which is sometimes offered through your employer. So if you make your contributions via an employer, they quite often are via salary sacrifice. What salary sacrifice does is it means the first thing that gets deducted is your pension contribution. So if you make a contribution of 10%, your salary is now 10% lower. When you apply for loans, typically they take multiples of your salary. So if your salary is now lower, then that's a multiple. Typically now with mortgages, though, they don't really look at your income, they look at what you're spending your money on. So I don't know if they look at it favourably, but I don't think it hinders you as much as it used to.
Right. Okay. So let's have a little look into that one, because that sounds like quite a good question we might want to come back to you on. But I think salary sacrifice, there's a question here on salary sacrifice as well, because someone said, is a salary sacrifice worth doing? So I know you speak to a lot of people about salary sacrifice. Have you got any thoughts on that?
Yeah, salary sacrifice is a fantastic benefit, and for 99.9% of people it's beneficial. So just quickly explain it again. If you're not paying by salary sacrifice, what you're doing is you're paying tax, you're paying national insurance, you're then paying your pension contribution, and what's left is what you see in your bank account every month to pay your bills with. If salary sacrifice changes the order, so the first thing that goes is your pension contribution. As my example, let's say your pension contribution is 10%, therefore your salary is 10% lower. Because your salary is 10% lower, you pay less tax, you pay less national insurance, so your take-home pay is slightly bigger, or that 10% is costing you less, whichever way you want to look at it. Also, you save on national insurance, but your employer also saves on national insurance. And quite often they rebate some of that saving back. Again, worth exploring with your employer. So sometimes not only are you making savings because you're not paying as much tax and NI, but you're also making money because your employer's rebating some of their saving in.
And back to your earlier point, when mortgage lenders are looking at lending money, if they're looking at your net pay, salary sacrifice can actually be a benefit because your net pay increases slightly. So I think sometimes there was a misconception that salary sacrifice somehow hindered your ability to borrow money. But that was back in the old days when lenders looked at a multiple of salary, but they tend not to do that. They tend to be much more kind of focused on, as you said, on your spending and what your net income is.
Yeah.
We've got time for maybe just one more question here, or one or two more questions before we wrap up. There's just one in here about the forecasting tool. Just wondering, are there certain assumptions built in about salary increases, inflation increases, all that sort of thing? And what can someone do about that if they're playing around with the forecasting tool? Yeah,
forecasting tools will have to make various assumptions. What happens to your salary, growth rate of your fund, things like that. So I know I could talk about the one that we use at Secondsight, for example, but all forecasting tools will have one. you may be able to change the growth rate of the fund, and the growth rate of the fund can have a big difference, and that will reflect on your fund that you've chosen and the amount of risk that you've chosen. So I'd be careful when you're talking about salary rises, because I talk to a lot of people that starting out in their career, and they say, well, I hope to have had X amount of promotions, and hopefully you will do, but you don't want to get this forecast so unrealistic that you don't really know what you're looking at. So we often say that salaries will match inflation, and then anything that any promotional pay rises you get are a bonus. But don't forget, when you get a promotional pay rise, your pension contribution goes up as well, because it's often a percentage of salary. So yes, there will be various assumptions. You should be able to change them.
Okay, and I guess that will depend on the sophistication of the tool you're using. Yeah. So have a look around on that one. A really good question here, which I'm sure you can answer specifically, because it's referring to maternity leave. And what happens if you go on mat leave and your contributions reduce? Obviously, this is really important, particularly, I guess, in addition to what you get from work, but also your state pension. Do you lose that amount, and would you have to work longer? How does that work?
Yeah, I've got a lot of experience in this. I'm about to embark on my 3rd maternity leave. So yes, when it's really important for women to remember that when they go on maternity leave, there's a potential gap in their retirement planning. Now, if you contribute via salary sacrifice, that contribution is continued to be paid by your employer. So that's always a good thing to know. If you don't pay via salary sacrifice, however, it's the net pay method. And if you're not getting any money, then the money is not getting paid into your pension. With regards to how it affects your state pensions, you have to have 35 years worth of national insurance to get the full state pension. So if you're just taking the 1 year, it probably won't make a difference. But maternity leave doesn't make a difference anyway, because it all counts towards it anyway. So that should be fine.
Thank you. I'm just going to put up a caveat warning slide here, which we have to do at the end of each session, which is just to sort of make sure that people know that we're talking about things generically. It's not advice, etc. Also an opportunity for me just to promote our session next week. Again, we will be running that on next Friday about budgeting, saving, investing. And then lastly, when you exit this Zoom session, you should have a quick feedback form. There's a link on there. We'd really, really appreciate it if you can complete that. It really helps us with our market research. It takes probably 20 seconds. I know we get bombarded for feedback, so I apologize. There's another one for feedback, but it really does help us. So if you could just spend 20 seconds of your time doing that, that would be amazing. Thank you very much for dialing in this morning. I hope you found that useful. I hope you're all going to enjoy fireworks tonight. And thank you very much to you, Caroline, for joining us and giving us your time. And yes, I'm wishing you all a nice weekend, and hopefully see you all next Friday.
Bye, everyone.
Bye-bye.